Imagine waking up to see the headlines. Dollar down 15% in a year, markets orderly, nothing to see here. Meanwhile, your savings quietly lost more than a decade of interest. In 12 months. That's the world we're drifting toward right now. And the wild part? A weaker dollar isn't a bug in the system. It might be the strategy. With Trump back in the White House, huge debt, and global pressure on the dollar, a controlled crash could be the only politically realistic way out. Today on the comments section with Thomas Paul, we're going to unpack why a dollar decline actually makes sense to the people in charge, how it could hit your portfolio, and why AI giants and hard assets might be the only safe seats left in the theater. Here's where things get interesting. Let's start with the setup. The U.S. is staring at tens of trillions in debt and pays billions in interest every single day. You don't fix that with discipline and a nice PowerPoint. You fix it the way governments have fixed it for 100 years. You quietly shrink the value of the money you owe. Warren Buffett has warned for years that the natural path of government is to weaken its currency over time, not because they're evil cartoon villains, because politically it's easier to hurt savers slowly than to tell voters, sorry, the party's over. Now add Trump. He has never pretended to love a strong dollar. He has openly complained that a powerful dollar hurts U.S. exports and jobs. Put that mindset in charge of the world's reserve currency at a time of crushing debt, and suddenly a weaker dollar doesn't sound like an accident. It starts to sound like a plan. But it's even getting worse to see how this plays out. You don't need a crystal ball, just a history book. In 1971, Nixon cut the dollar's link to gold. That was sold as a temporary measure. Spoiler, it wasn't temporary. It was the birth of the modern money printer era. Then in 1985, you had the Plaza Accord. A group of rich countries agreed to push the dollar down to help U.S. trade. It worked for America, and it wrecked Japan. Their currency soared, their exports struggled, and their asset bubble turned into 3 lost decades. The lesson for Washington? If you control the reserve currency, you also control the pain dial. You can spread your problems across the whole world by making every dollar worth a little less. And here's where things take a step further. For politicians, inflation is irresistible. You never have to vote for "we're defaulting on our debt." Instead, you just let prices creep up, wages lag behind, and the real value of what the government owes slowly melts away. My parents learned the hard way that experts can be wrong. They trusted a bank advisor, lost most of their savings, and we had a very quiet dinner table for months. That's why when I hear "don't worry, it's transitory," or "the dollar is strong," I automatically ask, strong for who? But then the unbelievable thing happened. Let's talk numbers. If the dollar drops, say, 10 to 15% against other major currencies, what does that actually mean for you? On paper, nothing explodes. Your bank app still shows the same number of dollars. But what those dollars can buy globally just got sliced. Think of it as a stealth tax. If you hold cash or long-term bonds paying you 3 to 4% and the currency quietly falls more than that, your safe assets are going backward in real terms. Ray Dalio has explained this for years. When countries inflate away their debt, the losers are the people holding the currency. The winners are those holding real assets or businesses that can raise prices. Here's where things get interesting. This is why the biggest players don't just watch the dollar index. They watch where the money is migrating. Lately, you see huge flows into 2 camps. Ultra-profitable tech with global pricing power, and old-school hard assets like gold. That's not a spiritual decision. It's math. If the unit of account is getting weaker, you want things that either 1. Can charge the whole world in whatever currency is strongest, or 2. Don't care what the currency is at all. In my early 30s, I bought boring, unfashionable assets while everyone else chased shiny, once-in-a-lifetime trades. It didn't make me rich overnight. It just worked, slowly. And I see something similar now. The loudest story is AI mania. The quieter story is AI companies are becoming the new safe haven in a world of soft money. But it's even getting worse. Look at the AI megacaps. They sell software, chips, and cloud services to the entire planet. If the dollar weakens, they can tweak prices, lock in contracts, and still print margins north of 30, 40, even 50%. That's called pricing power, the ability to raise prices without losing customers. It's the opposite of holding a bond that pays you a fixed coupon while inflation eats away your return. This is why comparing today's AI leaders to the dot-com bubble misses the point. Back then, many companies had eyeballs but no profits. Now, the biggest AI names have cash flows, buybacks, and global networks. They're not just growth stories, they're becoming financial shock absorbers. And here's where things take a step further. Follow the elephants, the giant institutional investors. When they quietly move billions into gold, infrastructure, and high-margin tech, they're not doing it for fun. They are positioning for a world where governments manage debt with inflation, not with honest budgets. So what does Trump's dollar strategy mean for you practically? Number 1. Treat long-term bonds like a hot stove. If your yield is below what you think long-run inflation will be, you're paying for the privilege of losing money. But then the unbelievable thing happened. Number 2, rethink cash is safe. Cash is flexible, yes. Safe, no. In an environment of intentional devaluation, cash is a melting ice cube. You still need it for emergencies, but parking a big chunk of your net worth there is a bet that politicians will suddenly become fiscally responsible. I'll let you decide how likely that is. Number 3, tilt toward assets with real pricing power. That includes dominant AI and tech platforms, high-quality companies that can raise prices without losing customers, and a slice of hard assets, metals, commodities, real assets that don't disappear when the dollar sneezes. Here's where things get interesting. This video was created with Fludge.io, the same system that powers this entire channel. If you're watching this and thinking, I'd love a channel like this, but I don't want to be on camera, this is exactly what it was built for. It researches topics, writes scripts, creates thumbnails, uses AI avatars, and uploads to YouTube automatically. Your job is to review, tweak what you want, and hit publish. Over time, it learns your style, so you end up with high-quality content without burning your life on editing software. It works in finance, AI, news, history, hobbies. Basically, if you care about it, you can build around it. But then he said this unbelievable thing. Now, circling back to Trump and the dollar. The big risk is not that we wake up one day and the dollar is dead. The big risk is that it dies slowly for savers while looking totally fine on TV. Headlines will say, manageable inflation, orderly currency adjustment, strategic realignment. I still remember when I got laid off during a so-called strategic realignment. It sounded so clever. What it actually meant was, regular people pay the price for decisions made way above them. Currency policy works the same way. The words sound calm. The impact is not. So what should you watch next? Watch the bond market. If yields stay below sticky inflation, that's financial repression in real time. Watch the dollar index. A gentle downtrend is more dangerous than a sudden crash because nobody panics. And watch where the real money is going. AI leaders, global oligopolies, and hard assets. Here's where things get interesting. By the way, this is not financial advice. It's educational commentary meant to help you think, not tell you what to buy. Talk to a qualified advisor before making big decisions, and remember, you can still lose money even when the theory sounds smart. Now I want to hear from you. Do you think a weaker dollar under Trump is an accident waiting to happen, or a deliberate strategy to wipe away the debt? And how are you positioning your own portfolio? More AI, more gold, or still team cash? Let me know your take in the comments. And if you want more videos that cut through the noise with a bit less panic and a bit more dry honesty, you know where to find this channel.